Okay, well, good morning, good afternoon, good evening, whenever you're watching this. This is Clint Laughlin with Kansas State Research and Extension, and welcome to our round number 3 of our Kansas State Research and Extension Cattle Conversation series. Some of you may have tuned in to our first 2 rounds here last spring. We are bringing this series to you again each Thursday morning from December 2nd to January 6th of 2022. It's a collaboration with multiple extension districts with Kansas State Research and Extension, including the Central Kansas District, the Cottonwood District, Midway District, Phillips Rooks District, Post Rock District, and the River Valley District. At this time, I'll just introduce a few of our panel of agents that have kind of been putting on this programming series. And oh, hold on. It won't let me move my screen. Huh. Hold on. There we go. Sorry, guys. Just had a few technical difficulties here this morning, but just again to announce our programming panel. We've had a number of good conversations, and so just to recognize everybody, we've got Justine Henderson. She's our livestock agent from the Central Kansas District. We've got Alicia Bohr. Lish is our ag agent, our generalist from the Cottonwood Extension District. Myself, Clint Laughlin from the Midway Extension District. Rachel Brook, our livestock agent of the Phillips Rooks District. And Blair Todd. Blair is our newest member of the team. She's our livestock extension agent for the Post Rock District. So as we kind of go through, just remember that for those of you that are tuning in, we've got multiple opportunities to ask a question. If anybody would like to ask a question to our specialist here this morning, please you can email your questions to my email address, cllaughlin@ksu.edu, or any of the agents that we recognized here this morning on the team. And this is also a good opportunity for those of you to get on and use Zoom. And if those of you are getting on later in this presentation, feel free to put your questions in the chat box that is located at the bottom of your screen, and then type in your question, and we will get to that when time allows. Our poll questions, we'll have a couple of those here this morning. So during our presentation, our presenter, Clay Simons, will be asking some poll questions. So simply click on your desired response on the screen, and the results for the entire group will be displayed. So at this time, I'll call on my colleague Lish to recognize our speaker here this morning.
Good morning, everyone. Today, our speaker is Clay Simons. Clay is an extension farm management economist with the Kansas Farm Management Association in the South Central area, and he's based in Hutchinson, Kansas. He works with member farmers and ranchers in South Central Kansas on a variety of farm management, economic, and tax management issues. He's a 28-year veteran of K-State Research and Extension, and he has been with KFMA since 2004. Simons holds a bachelor's degree from Texas A&M University and did graduate work at Kansas State University. And at this point, we will pass it over to Clay.
Okay, Clay, I'll stop sharing my screen so you can share yours here.
I'll start sharing mine then.
Okay, floor is yours, good sir.
And just a second.
It is. There you go.
Okay, can we see everything all right?
Yep, I can see it, Clay.
Are we good to go? Okay. First of all, thank Clint, Lish, everybody for having me here today. I realize this isn't the most exciting of topics out there, but as we're getting into the year end here, especially with prices and incomes being in general higher for a lot of producers out there, getting some plans in place before the end year as far as planning your tax strategy is a really good thing. Before I get into the meat and potatoes of actual tax planning, one thing I would like to remind everybody of, I'm not going to cover this a lot in there, but when you are visiting with your tax preparer going into next year, make sure that you visit with them about the employee retention credits. Those can be pretty substantial, and all you have to have is a 25% drop between a specific quarter in this year compared to the specific quarter in the year before. And those credits can actually add up, and those would be for any employees that you've had, except for employees that are related to you. And when we're talking related parties or related employees, that means just about anything, including cousins, aunts, uncles, brothers, and sisters. So those don't count, but be sure and visit with your tax preparer about that, because it is something that can make a big difference and get you a little more government support in addition to like the PPP loans and all that sort of stuff. Like I said, this isn't really a steak topic. It's more like Brussels sprouts, and we're not talking the Brussels sprouts that you get nowadays in restaurants where they're trendy and they deep fry them and they put some bacon with them and all that. No, these are the boiled Brussels sprouts that Grandma used to make, and she forgot to salt the water when she boiled them. But it still is a very important topic to go through here. So in general, tax planning strategies, there's two strategies out there. The first is to avoid tax, make tax as low as you can. Most farmers are like that. I haven't met a farmer yet that isn't adverse to paying self-employment tax. They just don't like to do it. Nobody likes to pay tax. But another way to look at it is taxes aren't something to be avoided. They are something that you need to manage. And if you are going to make profit and build wealth, you're going to have a tax bill. And so the way we kind of like to look at it in our organization is to optimize that after-tax income. You're going to look at your business, past, present, and future, look at your goals. You're going to try and take advantage of all the credits and deductions that you can get out there. But then you're also going to look at the marginal tax brackets and try to fill those up as best you can. Farmers, especially those that are cash basis accountants, they've got a lot of tools that they can use to manage tax liability. You can increase expense, you can decrease expense. You can do the same with income by increasing or decreasing that. You can use income averaging, and with some credits that are out there, you can also try to maximize those and set income up in such a way that you're maximizing credits and getting a little more bang for your buck that way. Just some general rules of thumb that over the years I think are really, really important in managing tax liability and income and profit and loss. First of all, if your inventory is changing, then generally over a period of time, your taxable income should change to meet that. So if your inventories are up substantially at the end of this year as they were compared to the previous years, then you should really be thinking about increasing your taxable income just so you don't kick the can too far down the road. Expensing equipment through bonus depreciation or Section 179 is fine, but if you're borrowing the money to buy that equipment, keep in mind that you're deducting something that you're going to be paying for over the next 5 to 7 years. And so maybe it's not all that wise to deduct that expense if you haven't paid for it yet, if you're making payments. And a general rule of thumb is that the amount of income that you should have on your tax return, your adjusted gross income, should actually be greater than your family living expense, including your income tax liability and your land principal payments. If your income is higher than that, then you have something left over to reinvest in the business. If it's less than that, then that cash that you're making those payments and living off is coming from somewhere. And generally it is probably from your line of credit. And eventually the banker's not going to like that. And so trying to keep your tax liability lined up with what your family living and your principal payments are at a bare minimum is what you should do. Okay, first poll question. I received a check in the mail on December 31st from a tax, on December 31st. From a tax and record keeping standpoint, should I, A, wait until I deposit the check in January to include it in income, for the current year, even though I did not deposit the funds during the calendar year, or I should tear up the check since I really don't need the money? So how long, guys, do I need to wait on this one?
Clay, everybody has answered the poll. Can you see the results?
It's over here on my other screen. Where this other one is, I'm going to pull it over here where it's closer. Okay. Most of everybody got the poll question right. This is the concept of constructive receipt. Constructive receipt means the point that you have control of the funds, which is when you receive the check. So you should be including that income in the current year's records, even though you have not deposited it. And the same thing works the other way. Say somebody writes you a check on December 31st and they put it in the mail and you don't receive it until January 2nd. Then you have a constructive receipt argument the other way. Even if they send you a 1099, you can still include that income in the following year. So it's when you receive the funds and have control in them, not when you deposit, is your rule of thumb for constructive receipt. Okay. Another tool that guys use to manage income is a deferred payment contract. And essentially what that is you are selling grain or livestock to a third party, and through a contractual arrangement, they are holding those funds until a date in the future. And generally that date in the future is after the first of the year. So you have the constructive receipt argument. It must be a written contract between the buyer and the seller. They just can't hold the check for you. And the elevator or the other party has to take title to that grain, those cattle, or whatever. And so you sell it, and contract it, you don't receive the money until after the first of the year. So it is, in this case, 2022 income. Now the buyer can go ahead and peddle that because they have merchantable title to it. Now, one question that I think is really important is a sale barn the purchaser or an intermediary? I would argue that a sale barn is not a purchaser of livestock. They are an intermediary between the buyer and the seller. Now, I know there are sale barns out there that will write January pay contracts and hold the check for you. But I do believe as a producer, you're taking a really big risk doing that. If you're audited and the auditor's paying attention, I think that is something that can come back and bite you, because under the Packers and Stockyards Act, a sale barn does not actually take title to those cattle when you're running them through there. They're just collecting the money from you or collecting the money from the buyer and then passing that on to you. And so I don't think that that a sale barn actually qualifies. Now, if you are selling to an individual buyer and have a contract in place, then there's no problem with doing that with livestock. Remember, these contracts, you have to have specific quantity, specific price, and you have to stand the risk of loss. So if the elevator that you're doing a January pay contract goes under, you're an unsecured creditor in line with the rest of them. So that's just a quick and dirty deferred payment contract issue. Okay, second poll question. Can I prepay expenses just by leaving a check with my supplier? True or false? False, that is correct. It's really the second bullet point on this. The part that we're going to talk about next is ways to increase expenses to manage income. When you're prepaying expenses, it can be no more than 50% of the total expense. You must have a business purpose other than tax avoidance. So, okay, I'm buying my seed before the end of the year because that's when I get my good discount. I'm locking in a price that I want for my fertilizer. That is a business experience, and it's not too hard to come up with a business experience. But instead of just parking a check with a supplier, you have to purchase specific gallons, specific quantity, specific tons at a specific price to make that prepay work. And you should really, as producers out there right now, be working with your suppliers. I mean, there are a lot of suppliers that are maybe a little leery about prepaying a whole lot and stuff like that because they're getting supplies from their suppliers. So just don't go in on the last day of the year and expect to be able to maybe get some product bought. You do some planning in advance this year because of the situation we are with input cost. Some things that you can't prepay, you cannot prepay rent, or you can prepay rent, you just can't deduct it. Insurance or interest cost. So you can pay a current interest that is owed, but you cannot pay interest to a lender in advance. Okay. Some other tools as far as increasing expenses would be accelerating depreciation on capital items. But always leave yourself some wiggle room. Don't plan on writing everything off if that's your kind of general thing. Leave something in your hip pocket so you can kind of do some planning and stuff like that. You can also maximize retirement contributions. Max that SEP out at, I believe it's $55,000 this year if you can. You can also make some large year-end charitable contributions if you're able to itemize. One other tool as far as charitable contributions that farmers can do. Now, if you're a 4835 crop share landlord, you can't do this. But you can always give grain to the church or to K-State or to whatever charitable organization you want to give it to. If you give grain, that reduces your Schedule F. You don't have to worry about itemizing, and it saves you self-employment tax. because you never claim that as income on your return, and there's nothing wrong with it. But if you are giving grain or another commodity, the institution that's receiving it has to control it. So you need to go down to the elevator and put 500 bushels of soybeans in the church's name and then have them sell it. Don't just sell it and say, make the check out to the church. Then you blow that deduction. Then it has to be an itemized deduction because that's considered cash. Other tools for increasing expenses. Well, okay, that's the same thing over again. So let's pass on that. So the next thing we're going to talk about is decreasing expenses. Say you're, need a little more income and you're trying to slow things down. You're having a bad year for whatever reason. First thing you can do is you can slow down depreciation. The default for farms is called 200% declining balance. And you can elect to use one of the other methods. Generally, if I'm slowing down depreciation on some items, I usually go to straight line. But there are several options you can use. And I'll have a little slide here next that shows you kind of the lifespan of depreciation and how it's front loaded under most methods. You can also capitalize some long life repairs. If you put in a new transmission that you could call a repair technically on your return and take all the expense and not have to capitalize it. If you're having a bad year, you could sit there and capitalize that and depreciate it out over 7 years in terms of a transmission or an engine rebuild and slow that expense down. And so that would effectively decrease your loss or increase your income. Also, if you could do the same thing with long life fertilizer expense, such as lime, you can sit there and capitalize that and spread that out over 3 to 5 years, depending on what type of fertilizer it is. These are the depreciation methods over time. The blue line is the default 200% declining balance. And you can see you get 25% of that asset's expense in the second year, whereas everything else is less. You get about 15% the first year, 25% the second year, then it declines out over the next 7 years down till it's depreciated out. If you need to slow depreciation down and you go to that straight line method, you're getting less expense in those upfront years. You get a little more expense at the tail end, but if you're having a bad year now and you need to, decrease your expense, that is a way to do it. Especially if you have a big loss on the year, you want to do everything that you can to avoid net operating losses. And so that's a tool that you can use to decrease expense without actually doing it. Some tax planning tools as far as increasing income. Sell your inventory. However, if the grain's stored in a bin at home, you might not be able to deliver and sell that stuff by the year end because you've got to get it to town. You might have grain contracted for next year, and so you can't do that. Or as a producer, you might not like the current price, which really isn't a problem right now this year in general, but that could be a problem. You could sell or trade in appreciated or low basis assets and recollect the gain on that. As far as equipment, So if you got a piece of equipment that you're not using out there that's depreciated out, you could sell it or trade it in on something else, and that gain would be taxable on your return. The next would be taking a CCC loan on grain. Don't see that much of that anymore because, as you can see, the loan rates are very, very low compared to what market prices are. And so you're not going to actually generate that much income. Plus, you've got to have some paperwork done, warehouse receipts if it's stored in the elevator and stuff like that. So that can be a challenge as far as taking a CCC loan on grain. Plus, whenever you redeem that loan, you've got some accounting issues you've got to take care of and be careful of so you don't count some income twice. Earlier, I talked about installment sale treatment on deferred payment contracts. If you have some grain sold in January to increase income, you can elect when you file your tax return to take the income on that deferred grain, even though you don't get payment until the next year. It has to be done on a contract by contract basis. And so if you went down and just in one fell swoop at the elevator sold $100,000 of grain to get the check on January 3, then you have to bring that whole $100,000 back, all of it or none of it. And so I generally advise my members to do it in bite-sized chunks, sell those deferred contracts in, $10, $15, $50,000 increments so you can pull back what you need on a contract by contract basis. Also, if you have some SEPs or some traditional IRAs, you can convert those to Roths in a low income year, pay very little tax on it, and then have that Roth IRA whenever you're drawing on it when you're retired, you'll have that income coming in tax free. You can also, if you are an S corporation that was a C corporation, you can do a deemed dividend, but that's a very rare and special case to where you can do that. Decreasing income. You can defer crop insurance proceeds. Now, you can only do that if the proceeds are received in the year that you produced that crop. And then you can only do that if you sell more than 50% of your grain in the following year. Now, so if fall crops, you generally defer half of those over into the next year, then you can defer any crop insurance you receive for corn or beans. If you sell all of your wheat predominantly after harvest and in the calendar year, then you could not defer any wheat that came. The other thing is you can only defer it for crop damage. Any revenue insurance or weather proceeds have to be taxed. And it's kind of a pain to sit there and calculate that. And so you do have to jump through some hoops to make sure that you're deferring the right amount if you're going to do that. Disaster payments, usually you can't defer it. And that's generally because those disaster payments are running a year or two behind the actual disaster, like the WIP payments that everybody received in 2020 and a few in 21. Those were actually for 18 and 19 production. So you've really already deferred those for all intents and purposes. I talked a little bit about this a second ago, but as far as deferring crop insurance, you do have to have some paperwork to figure out that right amount. So you'll need to get some paperwork from your crop insurance agents and make sure that you are doing it right and not deferring everything, because like I said, the revenue and weather policy income you cannot defer. Roger McCohen over at Washburn University, and he also does teach the Ag Law class up at K-State now. He has a nice rationale for how to calculate that, and the link's right there on the slide. A couple of other issues to consider if you're needing to decrease income is if you are affected by a drought, you can elect to defer the taxation on cows and calves. If you have a disaster declaration, you can defer that income to the following year only for those cattle whose sale were in excess of what you normally do. There is another method that's there for cows only that requires a disaster, that does not require a disaster declaration, but you can sit there and defer it for up to 2 years unless you have a disaster declaration. Then you can go out 4 years. And then as you replace those cattle, you have to reduce your basis in those cattle by the amount that was deferred. I typically don't like to defer cattle or crop insurance, either one. And in general, that's because you don't know what the future is going to bring. Sometimes it's better just to take your poison right now. A lot of times after a bad year, when you think you need to defer some crop insurance, well, you kick it down and you have a really good year and you're stuck with essentially selling 2 crops in the same year. So I think that's something you don't need to do. As far as deferring those cattle sales, look at the drought you can look at the drought monitor map and see where actual disaster declarations are and stuff like that. income averaging. This is kind of the last tool I'm going to get through right now. It's Schedule J. And essentially what you can do is elect to average into the previous 3 years any Schedule F income or gains from the sale of cull cows and equipment on 4797 to those previous 3 years. Pass-through income from S Corps and LLCs is eligible for income averaging. B Corps don't get to income average. And if you're selling farm ground, you do not get to average that as well. If you've got some low brackets from previous years that you didn't fill, you get to utilize those. It doesn't save you self-employment tax. And if you're selling capital gain assets, it's going to confuse the IRS. They have never calculated this right on raised cow sales. And so in a year that you're including that, just expect to get a letter. You'll get a small refund from the IRS. Your tax preparer probably did not calculate it wrong. We've worked for years with the IRS telling them, hey, you're calculating it wrong. They don't care. Cash the check and go on in general with that. But here's an example of income averaging right here. You've got 17, 18, and 19 income that's been decreasing for several years. 2020, you had a pretty good year. You got up to $120,000 of farm income. Well, we're going to take a chunk of that income and apply that back to the 3 years. Now, when you do that, you have to divide it in 3 equal portions. We just don't get to put it all in that one low bracket. And so we're taking a third of the income and putting it in 17 on top, a third in 18, and a third in 19. Well, most of that bracket, the income in that bracket for 20, if we were just taxing it regularly, would be taxed at approximately 22%. Well, in this case, we're getting 2/3 of it taxed at 12% and the rest at 22%. So income averaging is a good tool. And it's especially good if you're in your last year, you've pushed a lot of income forward, pulled a lot of expenses back, and you've got a really, really high income. Maybe you've had a farm sale too, got rid of the equipment. You can really use income averaging to help shield on that tax liability. And so with that, that's in general the material I had to cover as far as managing income and expense for taxes. So if there are any questions, I'll take those at this time, I guess.
Clay, there was one question in the chat Jeremiah submitted.
Okay.
Let me get to it. It says, I'm surprised by the only 50% of total prepay expense. Is that by item or is that total expenses?
That is total expenses. That is total expenses for 3 years on average. So you can go over, but that is one of those things, if you're ever audited, you just need to be able to document it. And so, but in general, 50% of your total expenses are what you're allowed to prepay. But there is an average over 3 years and it's anticipated expenses. So, I mean, there's some wiggle room. You can go over that, but in general, no, that is the limit. So buying everything for a crop for the next year, technically, no, you shouldn't deduct that. And if you were ever audited, that could come back and haunt you.
Well, I don't see any more in the chat, and I will add here, if you are watching this at a later time and you have questions and concerns or need something clarified, feel free to email any one of us and we can either get you in contact with Clay or we can make that connection for you. I'm sure that if you're watching this at a later time, you might have questions, so please feel free to reach out to us because we want to get those answered for you.
Hey, well, thanks everybody for having me. I enjoyed it.
If there are no other questions, I'll go ahead and just thank everyone for joining us today. A reminder, our series will continue next week on Thursday, December 9th at 10 a.m. again. We'll be joining, or Dr. Allison Crane will be joining us. She's a Kansas State sheep and goat specialist, and she'll be discussing co-grazing. So tune in again on next Thursday at 10 a.m. We also want to remind everyone to take the survey and let us know your thoughts, and we'd really appreciate it. So thanks again for joining.